Our guest this week is Nick Moran, the founder and general partner of New Stack Ventures. Nick is also the host of The Full Ratchet, the first VC podcast that started back in 2014. We discussed how New Stack adds value, why Nick is focused on deals outside the Bay Area, and why access is overrated. Please enjoy. Nick, thanks for joining.
Joe, it's a pleasure. Thanks for having me.
So you're normally on the other side of the mic. How about you get things rolling by telling us the origin story of New Stack Ventures?
Origin story of New Stack. So I turned out of corporate America in 2013 and had this vision to be a startup investor. And building a venture firm is a little more difficult than just having an idea. You can't really, raise $1 million and experiment, with product market fit right out the gate. It's sort of a slow grind. And so I started angel investing. As you know, I started the first VC podcast in May of 14. That was my idea for sort of getting out there and networking and hopefully getting some deal flow. It worked a little better than expected. People were very pleased to, they wouldn't respond to my emails when I was just an angel, investing in Chicago. But when I showed up with a microphone, who's who of investors were very pleased to jump on a call and talk about themselves for an hour. And it worked quite well. And then deal flow started flooding in. Fortunately for us, there was a platform that launched called AngelList, and they created a product called syndicates. And so we were an early syndicate on their platform. I was able to message to the audience and say, hey, if you want to see the deals I'm angel investing in, join my group. And the group grew quite fast. And so my $25K check became 100, 200, 300K. We were able to lead deals at pre-seed. Did 10 of those, had really good luck with the first 10, raised a pilot fund in 18 of 6 million and change, and then raised more of a proper venture fund in late 2020, which is 42 and a half. So we're investing out of that. We have our last 4 deals at the very tail end, and we will raise 150 later this year.
Awesome. And what is a classic, and I know there's a range, but what does a classic New Stack deal look like?
Well, it all starts with the founder. Like the quantum unit of success in investing, I think, is the startup, finding the right startup. And the quantum unit of success within the startup is the founder or founding team, particularly the CEO. We like people who are extraordinarily tenacious, maniacal, obsessive, dialed in, have charisma, can recruit a team, can close big partners, can get investors involved. We like really unique human beings. So we index and we optimize around founder mindset more so than anything else. And a lot of the founders we invest in are kind of in our own mold. So they've kind of beaten the odds. They don't have the bright, shiny Stanford, Google, Bay Area resumes. I think you and I are co-investors in a founder who's based in South Carolina. Mm-hmm. Now, who is building a startup in South Carolina? Most people will dismiss that offhand. I lean into that. I'm like, if this guy has been able to generate, millions of GMV and ARR on a shoestring, in a tier 3 market, there's got to be something interesting there. So we optimize around the founder, and then our tagline is investing in outsiders. So like I mentioned before, we're not going to lean into Ivy Leaguers. We're not looking for people that came from big tech like Google and Apple, and we're not looking for people in the Bay Area. We're looking for true entrepreneurs that can beat the odds and maybe come from industry. Maybe they come from real estate or insurance or banking, and didn't grow up in tech. So that's kind of what we look for.
Is it partly, I'm going to throw out a few options on the menu, and you can tell me which ones resonate. Is it a mix of that they have a non-consensus view, or they focus a little more on capital efficiency, maybe because they're not in a prolific venture market, or is it that they, frankly, valuations are a little more attractive once you get off coast? Is it some combination of that?
I think it's all of the above. right? Those are like second order effects that happen when you get like first order things right or first principles right. And ultimately, investing is about arbitrage. So price in, price out, minus dilution. And so everyone needs a way of arbing valuation in some way. And we think we get much better prices. We only invest in AAA assets, but we get B prices. So it's not a value strategy where we're investing in B assets. I would put our assets up against the best of the best coming out of Silicon Valley, and we get much better pricing. And so from an LP standpoint, that's been quite attractive. Our LPs are very pleased. They're very excited. They're like, when are you going to be done with these 4 deals and launch Fund 3? And it makes me really happy to hear that.
It's great to hear that from LPs, for sure.
It's great to hear that, right? It's great when your LPs are trying to get more money in. It's great when you can take your existing base of LPs and know that it's going to double. That makes, your fundraise, much more healthy. And so ultimately it's an arbitrage game. But yeah, you find these founders that are overperforming in every dimension and are learning animals. And there's much more signal than noise. When you're looking at everything coming out of Stanford, there's a lot of noise. You don't know who the true entrepreneurs are because they all have such bright, shiny resumes. And often as a VC, you have to chase those. The hottest deals in the Valley get chased. We don't chase. Our founders and our businesses chase us, which gives us a proper opportunity to diligence them. And to
Are you
find out
saying
what
you
they're
don't
really
do
doing.
uncapped safes on pre-seed deals?
Not yet.
Not yet. Okay.
Hopefully never.
You're in Chicago. I love Chicago. Amazing city.
Yeah.
It's not often a city that comes up from being a venture city, but it's a top 10 one. Can you tell us about the venture scene in Chicago?
It's pretty robust. I mean, it's grown a lot. When I first got here and was doing angel deals, it was not good. Not good at all. The people that were doing deals were kind of screwing them up at go. A lot of like LBO, PE types, a lot of traders doing deals. And the classic deal from like the most prominent firm in town was a 4-on-4. So they'd invest $4 million on a 4 pre and take half the business at entry. And so
I can hear founders cringing just from
it was crazy because we had been out west. I moved back to Chicago when I left corporate America, and the deals here just looked wonky. So the good news is there was a opportunity. There was a wide open lane to bring more of a modern mindset to the industry and do investing that was mutually beneficial, right? If you screw up in the investment at the beginning, you're destroying long-term potential returns. Whereas if you create something that's beneficial for the founder and the investor, set it up properly, then you can grow that startup and graduate them to Series A and B. So Chicago wasn't good at the time, but it's grown a lot. I mean, when we started the syndicate in 2015 on AngelList, I started a breakfast group for emerging managers. So people that ran funds 100 million and less, like founding partners. And there were 5 of us. There were 5 people going to that breakfast at the time. Now that breakfast is more than 50. Wow. I don't know the exact number, but there are a lot of people running around with different funds, esoteric funds, different strategies, different specialists. And to see that kind of growth on the capital side is wonderful because, great founders do need a capital base to kind of get to the next level. So I've seen a lot of growth. We do deals in Chicago, maybe 1 a year, maybe 2. It's not our only market, but we try and stay close to it and love a great Chicago founder.
Maybe to turn a little bit back to founders, when you're working with startups, how does NewStack approach value add and supporting founders?
Oh, boy. I'm going to say something not super popular here, which is platform is bullshit. Like, there's a lot of venture funds out there that are pitching platform. Andreessen was kind of the first one to do it on a big scale and do it very publicly. And when I ask founders that have worked with various platform VCs, how is the platform? The typical response is fine. It's not terrible. It's not great. it's fine.
If you're British, that's not so bad.
That's a good point. Touche.
But for an American, it's weak sauce.
Well, I mean, so like anything I do as a venture firm, anything we do with the CEOs and the founders of our companies, we want to be described as exceptional. Like every time we do something with NewStack, whether it's like an in-person CEO summit, a virtual summit, an AGM, anything, a process we run for capital raising, we want them to be like, it's extraordinary. It's way better than anything we've done. And so what does that mean? It means that we have to pick and choose and focus on very few things to do and do really well instead of boiling the ocean with services. Oh, we're going to do all these services. We're going to hire the best people in the industry. And guess what? 3 years later, those people are no longer the best. They've had a cushy, high-paid job, and they're no longer getting out and hustling on the accounting front or the PR front or the talent front. And so a lot of this platform out there is just not good. And so what do we do best? I think we do graduation to Series A best. Our follow-on rate is 92%. We help our companies raise follow-on capital. And my promise to the entrepreneurs is there's no one else in the middle of the country that's going to make introductions to 95% of the founding partners and general partners at every tier 1 Series A and B. We can do that, right? Because we've hosted them on the show for the last 10 years. And when you spend a meaningful hour with somebody like you and I are doing now, they will pick up the phone when you call, especially if you call about the right stuff. If it's a fintech VC, I'm not picking up the phone and telling them about my e-commerce stuff, right? And so what that means is I think we have a powerful Rolodex, not of just investors, but of decision makers. And that makes a difference, right? We graduate a lot of companies. They get their choice. They can take their term sheets from usually many options. They don't just have to take the one term sheet they get. And that provides a lot of leverage and a lot of advantage to founders. And so we focus on doing that really well instead of doing 10 things mediocre.
Your brother works at NewStack?
He does.
I think that's awesome. I would love to work with my brother. Is that, I guess, how did that bubble up? Did he come into the business later, or were you guys working together from the start?
So when I first started angel investing, the two of us put together an entity and we angel invested together. He has a legal background. He was a patent litigator. And so he would help with contracts. He would help with term sheet reviews. I would do all the sourcing. I would do the vetting. And then he was legal and he brought a check. So we would cut an equivalent check. So from the very beginning, he was really interested in the segment and investing. And then over time, as things formalized, I think he joined full-time in 2018 or 19. So it was, 4 or 5 years after we had started. We actually had a little bit of management fee so that, people weren't starving. But he left the legal profession and joined NewStack full-time at that point. And it's great. I mean, having a lawyer on staff, having my big brother, who's the smart one in the family, I mean, it's really helpful because I can trust him with the money. He does all the capital calls. He runs all the wires to the companies. He's an interface for all the LPs. We have 140 LPs, I think. And so we need somebody that can manage capital calls and interface, et cetera. And it needs to be somebody I can trust implicitly. I would not trust just anybody that I like with that kind of money. We're dealing with real money here. And the first rule of investing, don't lose your investors' money. And so we take that really seriously. And it's great to have my brother on board.
Please tell me that you guys settle disagreements by playing Madden or something like that.
We do get into poker every once in a while. And unfortunately, he typically gets the better of me in that.
I want to go back to your background on the corporate side. You kind of, the origin story kind of bounce out of that into venture. You worked at Danaher for 6 years, which for a lot of people on the venture side, they're probably less familiar. People with a public market background would know, fantastic history of value creation over a very long time. I'm curious, what did you take from that experience, let's say, to the positive side?
Yeah. to the positive side. So a heavy respect for building long-term sustainable competitive advantage. Danaher's really good at M&A, but they only acquire businesses that typically are somewhat monopolistic and have a significant brand advantage in their space. So they'll acquire platforms, they'll acquire smaller businesses to bolt onto platforms. And when you have such an advantage, a brand advantage or a product advantage over all of the competition in a segment, that gives you incredible power, pricing power, right? Many people don't know this, but Danaher aggressively increases pricing across their entire portfolio twice a year, every year. This is a little known fact about Danaher, but we were mandated. There's very few things that can come from corporate. Every business can run as a micro, but one of the few things that comes from corporate is you have to aggressively increase price. And when you've got best-in-class product in a market and you have a moat and a sustainable competitive advantage, customers continue to buy, right? They bristle a little bit. Ooh, geez, you're raising prices again? But they're not going to go to, a tier 3 offering versus a tier 1. So I learned a lot about the types of companies to invest in and what it means to build that advantage over time. How does one build a brand and a product that is 10x better than every other product in the market? I also learned an investment playbook, which was really helpful. Doing venture is different. Joe, you know this, like early stage stuff is different than later stage acquisition stuff. But that was really useful. And then I was fortunate that Danaher's not good at innovation. And so they tapped me on the shoulder and said, go build one of the most ambitious things we've ever endeavored to do at Danaher and just figure it out. So that was nice because I got to write the playbooks. I got to come up with the positioning, the pricing, the launch strategy, go to market. I made every decision on a product. It was a really ambitious analytical product. And I kind of got to write the story and even raise capital for it. We had to raise capital internally 3 different times. And so I kind of had a pseudo entrepreneurial journey and was able to kind of chart the course myself instead of just dusting off some innovation playbook off the shelf and trying to, launch a product in that context.
That's a pretty great setup for someone going in and start a venture firm. I certainly can see the path there and seems pretty clear. How do you think about pricing? Or when you're talking to your founders and you talk to them about pricing their products, their services, how do you go about that? From a Danaher background, the perspective might be you'd be surprised what people are willing to pay. But on the other hand, I find founders are usually pretty reticent to price with confidence. What's your perspective and general advice when you're talking to founders and pricing?
I mean, it's helpful to start with the framework. I like to start with frameworks for everything and then pivot and audible from there, right? Most of the people we work with are pretty smart, pretty creative, pretty innovative people. But if you start with a baseline, that's helpful. So if I think about pricing, the first branch of pricing is, do you have a service-based or a custom product, like a small number of customers, but high variability? Or do you have low variability of product, lots of customers that lends itself more to product-based businesses instead of service? So that's kind of the first branch. If we take the product branch further, there's 3 ways to price, right? There's cost plus, there's pricing based on comps, and there's pricing to value, right? So how much value is the customer getting for something? You need to think about all 3 of those when you're pricing in a market. It's tough. Like when you see let's say a sales enablement SaaS tool, right? You see a million of these. It's CRMs and Gong and whatever. It's very hard to just price that based on value right out the gate because customers are so anchored on, I will pay $60 per rep per month max, or something along the lines of that, right? So comps are very important, to respect when you're launching a product in that space. Because even if you're launching a gong that makes a salesperson 10x more effective, and you should be pricing it at 10,000 per rep per month, like you'll lose them at hello, right? Like the customer will go, this is madness. And so you need a healthy respect for like cost plus comps and value add. And then as you earn more respect and success with a customer over time and your brand equity increases, you can leverage your pricing scheme to greater effect over time. Maybe you transfer from a standard subscription, which is what they're anchored on, to a metered service, so it's based on usage. Maybe you launch additional products because you realize they love the core, but they really need this one-click button tool to like fire off a bunch of like pre-written emails as an example. And you can upsell on that, right? That's a value-added upsell. So yeah, I think it always starts with the framework, and you can't just price to value, even though pricing to value is the Shangri-La. That's like the holy grail of pricing, because you need to understand the way that their cost, you need to understand their cost structure, and you need to understand where they're anchored from a comparable standpoint.
You've done 791 episodes of the full Ratchet.
Is that right?
As of recording, it's about a decade. That's pretty incredible. How do you keep things fresh? I mean, that's just, the volume of that is so much. I'm sure there have been ebbs and flows along the way. How do you keep yourself engaged, excited, just personally, not even on the listener side, but just for you, keeping it fresh and interesting?
That is a great question. This has ebbed and flowed. You asked the right questions. The great thing is when you recruit people you really admire that have done unique things, it's a rare opportunity to have a captive audience and have the chance to ask any question you want. So like last week, I interviewed Alan Patrikoff and his partner Abby. I interviewed 2 weeks ago, I interviewed Frank Rotman. 3 weeks ago, I interviewed Tom Tungus, right? These people have all built very different types of firms at different scale from different generations, different return profiles. There's just, I could probably spend 5 hours on a call with them asking a laundry list of questions about their journey and how they built and how they thought about it and how their thesis evolved and how founders have changed and how markets have changed and where's the puck going? Where should we skate to? So a lot of it just has to do with continuing to find people that I think I really admire and really emulate and recruiting them to the show. The other piece is kind of structurally just the format. We're doing an interview format. I've done that for 10 years. There are different types of formats in media. There are different approaches, and I'm always experimenting. So I've got a backlog of like interesting different types of content that have been recorded over years, and we're thinking about how to package that up and release it. And that kind of keeps me going because I'm able to innovate on product, and then even within product, find the most interesting conversations that get me super fired up.
What is your favorite question to ask guests, and how can I repackage it and use it myself?
One of my final questions is, do you have any habits, tactics, or techniques that are a secret weapon? I like the question because a lot of great investors really distill down one thing that they've done, time and time again. And it's usually something very simple, but something very powerful. So like Roger Ehrenberg, his response was routine. Every day, he does the same thing. He gets up at the same time. He exercises. He has his cup of coffee. He reads. He has the same schedule. And because of that, he has consistency. He takes a lot of decision-making and noise out of his system, and he's able to operate really effectively. So I like that question. I also like asking people, for the greatest lesson they've learned that's changed the way they invest. A lot of people in this industry are really proud. A lot of folks I have on the show have had a lot of success, and to ask them kind of what they screwed up and how it changed the way they approach, their profession, sometimes that elicits really powerful responses. So those are a couple.
I feel like I've got to ask you that one then. So for you, on the journey you've been on, what has been a big, learned a lesson here?
Never compromise on the founder and how much the founder cares. There's one thing you can't teach in this business, and it's how much a founder cares about what they're doing. You can't rewire that. They either really care or they don't. And if they really care, obviously it needs to be an interesting opportunity, an interesting market space. They need to have the right skill set. There's a lot of the standard things that anyone can do in diligence. Anyone that has some business skills can run a diligence process around that. Very few people can pick out the individuals that have that rare, unique mindset where they've made a choice to succeed and there is no other choice. There is no other path. They will succeed. It's like when we raised our second fund, we were sizing up from 6 to over 40. We ended up at 42 and a half. We made a choice. Oh, we will raise this. People would be like, well, what are you going to do with portfolio construction if you only get to 15 or 10 or 20? It was like, oh, well, that won't happen. And they're like, well, what if it does? It won't happen. We will build the playbooks and we will build the top of funnel and we will refine our pitch and our product and we will get there. And if we get a 500 no's, we'll put 500 more people in the top of the funnel. We will build a machine around it. And so I like founders like that really, really care. We were doing interviews yesterday with some senior candidates, came in for investment interviews, and we were showing them videos of founders. And every candidate, in response to one of the videos we showed, said, that founder seemed a little over eager. I didn't like that. And our core team here, we invested in this business. Our core team here loved it because the founder is so committed, so obsessed, and excited, frankly, about what they're building. This founder cares so much about freight. Joe, I don't care about freight. I care a lot about people and my business. I don't care about freight, but this guy is obsessed with freight. He's so excited about it. And every candidate missed that. And so I think if you want to be a really good investor, market-based investors, business model investors are a dime a dozen in this industry. There's a lot of very well-educated people that can pick a good business. There's very few people that can spot somebody who really cares.
You've had conversations with hundreds of early stage investors over the years. Probably got a very good handle on what conventional strategy looks like. What do you think is a conventional point of view in venture that's very widely held that you think is bullshit?
This is an access game. It's not an access game. I think if you're all chasing the same deals, then you think it's an access game. You have to get access. This is not an access game. This is a picking game. We looked at over 12,000 deals last year. You know how many we invested in, Joe?
11,000?
We invested in 12, right? What was most important was not getting access to the 12,000. It was the 12 we chose. People think that a thesis alone will allow them to have success in this industry. You hang a shingle, I'm going to be a fintech fund. We're going to look at everything in fintech at seed. We're going to build networks in fintech. That's great, but that just gets you to the dance. All right, you can see all 5,000 fintech deals this year. Which 5 are you choosing? This is a selection game. It's not an access game. And if you're chasing like everyone else in the valley, you're going to continue to repeat this naive conventional wisdom that venture's an access game, and it's just not. It's all about selection. You've got to outpick everyone else to be top decile.
I love that. I agree. I love that. Your shows end with a mantra of you saying, over prepare, choose carefully, and invest confidently. I hear the choose carefully there. Can we talk about over prepare and what that means to you?
Yeah, like we just got done talking about access and picking, right? In selection. I think a lot of investors out there have a thesis, but they don't have a strategy. And to be successful in venture, you've got to prepare and you've got to figure out what your sustainable competitive advantage is, i.e. your strategy. Very few venture firms have one. You know, I see you could probably go to all these emerging manager pitches. I do. I help a lot of emerging managers through different programs, you know, get started and think about how to raise. They do not pitch the way a startup pitches. Like the best startups, you know, they talk about what's happening in the market. They've identified a problem. Here's a solution. Here's how it's defensible and sustainable and how we'll create a moat over time. Fund managers don't speak that way, which is ridiculous. We should be doing the same thing. It's not just about having an idea. Oh, we've got a thesis. We're going to do fintech. It's well, what's your sustainable competitive advantage? You've got to prepare. You've got to build. You have to figure out why you're going to win, why you're going to outsource, why you're going to out-select, and why you're going to win against other VCs. We win like 88%, 90% of the deals we offer. Most of my friends in the Valley are under 50%. I think the average, you know, when I poll people is about 45. Okay. So they're building portfolios of their second and third choices. They're getting in less than half the deals they offer. That's not good, right? We need to win deals. Figure out what your competitive advantage is. Figure out how to close a deal. Like when you're talking with a founder, why should they take your money? Many firms don't do this. So the preparation piece is important because we all need to have a strategy that goes beyond just the thesis, in my opinion.
Feels like you're probably butting up against the ceiling of as high a win rate as you can get for where you're focused. For that other 12% where you get we really appreciate it, but we're going to go in another direction, what's the most common reason or feedback you get?
Yeah, I'm trying to think about the last one that we lost.
That's a good sign. The fact that you're struggling to come up with a sample is probably enough there.
I don't remember the last one we lost. I mean, we almost lost one recently. It was a YC deal, and it was really competitive, and we were the lowest price offer. We're typically the lowest price offer, and we still win. And it was really tough for them. I mean, they did reference checks with every YC deal we've ever invested in, and they called me up and they were like, "Geez, man, like these guys love you. We've got to do it. Let's figure it out." But yeah, I mean, the cop-out answer is round construction. So we need at least 10%, 10 to 15%. We're an ownership-focused fund. So the cop-out answer is there is no path to 10%. They've already got a lead in place. They've already taken commitments from other investors, and they can't get there. But the reason that's a cop-out answer is because if you're a real founder, there's a creative solution to everything. The answer is never, we can't find a path forward. There's always a path forward in everything. You can always find one if it really makes sense. If it's a must get, you figure it out. You figure out something, right? So we've gotten really creative. I think there are times where we get caught up in the process. We get caught up in the raise process, and we make offers to startups that maybe ultimately aren't the best fit. We don't have a shared cultural philosophy. We don't have a shared mindset. You know, we've gotten caught up in a chase a few times. Like I said, most of the startups chase us, which is great because then we have a real opportunity to vet them. But there have been times where we get caught up in the chase. Oh, people are offering, the round is heating up. And sometimes with those, we don't have the same mindset. The founders believe this is a different build and a different way to have success in venture than the way that we believe companies should be built. And we have offered a couple of those, and then we've kind of arrived at the right conclusion, which is maybe this isn't the best partnership.
I wanted to wrap up by asking the best way for founders to get in touch with Newstack. But before we get to that, I want to go back to 12,000 deals reviewed, making 12 investments out of it. Can you talk about what the funnel management looks like for working through that, 1,000 to 1 process, and how you manage to keep, as a picker at your core, how you are able to do that with the volume of pitches coming your way?
Good question. So we have a lot of process here. Danaher's good at process. So we try and stay very organized. We measure everything. We have different stages in the funnel. We have very specific requirements we're looking for at each stage. And that even goes all the way up to what we call the pre-filter. So think about the mouth of the funnel. Before we ever take an intro meeting, we have a method by which we are pre-filtering the startup. We can kick it out of the process for obvious reasons, like it's not a thesis fit. Maybe the startup's based in the Bay Area. We don't do that, right? So you kick it out. There are less obvious reasons to kick it out that have to do with the founder's profile and their presence online and maybe the market or the way they've positioned the business. Once they do get into the funnel process, we've taken a meeting with them. We're just merciless with passing. I think it would be tough for a lot of people to join our firm because there's a lot of bright, shiny objects out there that they would just have to pass on very quickly because they don't meet our standards. And so we've kind of started with what is the entrepreneurial mindset and what are the characteristics in that mindset that are most important for us. And then we've taken each characteristic and distilled a set of tactics. What are tactics we can use to test somebody's tenacity, to test somebody's follow through, to test somebody's attention to detail, to test somebody's storytelling ability? These are all things that you can test. The more time you have, the better. But in an initial intro call, you can get some signal on those things. And then we just mercilessly pass. But the greatest advantage to being an investor versus let's say you're interviewing somebody for a job versus you're interviewing an investment, a company for investment. The biggest advantage is we have time, right? So not only do we ask them questions and get their responses and then verify those responses, but we can observe them typically over a couple months. When you're interviewing a candidate for a job, you don't get the observational benefits. And it's during that observation, asking questions, watching the way they behave, watching the way they act, that we can get to a pass pretty quickly.
All right. So it's 1,000 to 1, but if there's a founder out there listening and they'd love to work with you at Newstack, what's the best way for them to do that?
It's nick@newstack.com.
Awesome.
Send me an email there, or team@newstack.com works too.
Great. Well, Nick, this was a really great conversation, really fun. I appreciate it, and I want to try and make one of your emerging manager breakfasts sometime in Chicago.
Love it. Let's do it, Joe.
Hi, Joe again. Thanks for watching the show. If you'd like more of this in the future, subscribe to our channel. If you'd like to learn more about Seaplane Ventures, just check out seaplaneventures.com. Cheers.